Okay, everyone, we are going to go ahead and get started. I want to thank you so much for joining this Windermere workshop called How's the Market? I appreciate your engagement with this, whether you're watching live or listening to the recording. We just like and are really grateful that you are engaging with this webinar and with our company. My name is Eric Thompson. I'm going to be your host as we go through this information together. I am the president of Windermere Real Estate here in Colorado, and it's my mission to bring you a whole lot of clarity as we go along today. The market is changing. We're noticing some changes more than just seasonal changes. You know, it always slows down this time of year, but we're noticing some things that are different, and so that's why we are putting this together. I want to make sure that everyone listening in live can hear me loud and clear. So if it's okay with you, I wanted to have some fun and see if you could type into me, number one, that you can hear me loud and clear, and then how about you tell me your favorite football team, all right? So football season is kicked off. We got the Broncos playing, although they kind of stumbled their first game out of the chute against the Raiders. We got the Broncos going. We got the Buffs. We got the Rams. We have high school football going. So how about tell me your favorite football team? So they are the comments are coming in. They're rolling in. I'm seeing lots and lots of different teams that are being represented here. Gosh, even the Packers, I just noticed that. So how about that? So lots of different teams that people are fans of. That's fantastic. It's football season, and that's fun. And you're going to see at the very end of this, we're going to have some fun with a football metaphor. Also, I want to encourage you to stay to the end because I'm going to give you some resources and tell you about some things that you can get your hands on to give you even more clarity about the market. All right. So as we kick off here, I just want to make sure you know a little bit about our company. This is where we're located. This is where Windermere Real Estate is located all over the Western U.S. We're in 300 different locations. We have 6,500 agents all over the western part of our country here to serve you, and we are growing up and down the Front Range of Colorado. We have 5 different locations in Colorado to help you out, and we have people tuning in from all over the state, and we greatly appreciate that. So here are the questions that we get now. Here are the questions that we've been getting a lot of lately, and really the inspiration behind this webinar. All right, so as I mentioned before, we noticed some things that are different in the market, and we've been getting some questions, and so that's why we put this webinar together in the first place. So here are the questions that we're getting. We're getting the question, of course, what's going on with prices? So are prices still going up? I'm reading that things are slowing down in the market, or maybe even more than slowing down in the market. And so what's going on with prices? We're getting that question from our clients. A big one we're getting, especially lately, gosh, especially over the last couple of weeks, is what's up with the low rates. So mortgage rates keep dropping. They are at their lowest level right now since October 2016. This is one of really 3 times in history where they've been around 3.5%. We're going to look at that in more detail. So that is a big question that we're getting here lately. Of course, we're getting the question, is now a good time? Is now a good time to buy? Is now a good time to sell? Should I wait? What's the best timing? Of course, that's a question on people's mind. We're going to answer that one. And a big one we also get is, so where are all these people coming from? So all you have to do is just drive up and down I-25 and you see some differences in the traffic. It's kind of good news and bad news. It's certainly good news for real estate, good news for our economy, and for sure there are more people moving here to Colorado. So where are all the people coming from? We're going to answer that. So the deal with this webinar is you're going to get a ton of takeaways about the market. As I mentioned before, you'll get a whole lot of clarity. You won't just get takeaways. I'm going to share with you a lot of the research that we do. You'll see the numbers behind this. You'll see our sources of information and what we use to track the market. You will also know, and you may be relieved to know, there is no test at the end of this, so never fear, we're not going to send you a test that you have to pass. And also, I'm going to try to make this as fun as possible as we go along. So hopefully that's okay with you, that we have some fun. There are 2 really important concepts that I want you to understand as we embark here, as we get going. I want you to just know these kind of at a foundational level, and these will be themes that are interwoven through this whole presentation, these 2 concepts. The first one is that markets seek balance. So I studied economics at the University of Colorado. So this is like just a fundamental economic principle that all markets seek balance over time. So what that means is in any market, there are cycles, okay? So a real estate market, a stock market, a commodities market, whatever it is, there are cycles in that market. Of course, things cycle up and they cycle down. But always we can find a long-term trend. You can always find a long-term trend within that market. And so what the market's always working to do is get back to that trend. So the economic term for this is called the regression to the mean, kind of a fancy term for that. But a simpler way of saying it is simply that markets seek balance. So just know that all markets seek balance over time. So we're always looking for what is the long-term trend. I'm going to show you long-term trends in front range real estate. The second concept I want you to understand, and this is really more of a metaphor than a concept, but we think this makes a whole lot of sense right now. We think this is really meaningful and significant and really paints the picture of what's going on right now. Our market is like a flight of stairs. So imagine a long, long flight of stairs, many, many flights of stairs going up either outdoors or indoors, it doesn't matter. But what our market has been doing over the last 5 years or so, it's like we've been running up this flight of stairs, okay? Running, even sprinting up this flight of stairs. Eventually, you're going to get tired, okay? So if you or I were running up a flight of stairs for a prolonged amount of time, what's going to happen is that we're going to get tired and eventually we won't be able to run anymore. We're going to start walking up the stairs, right? So we still want to get up to the top of the flight of stairs, but we're going to hit a point where, you know what? We're just too darn tired to run. We need to walk. And so what we're noticing is that the market is starting to walk up the stairs. Maybe it's still running in some places, but it's not running as fast. Maybe it's more of a jog than a sprint. But the deal is that we're still going up the stairs, all right? So it's not like we're now walking backwards down the stairs. And specifically what I'm talking about are prices. So you'll see when we look at prices, prices are still going up, just not as fast as they were. And we know that, of course, they couldn't have sustained the pace that they had for the last 5 years, just like you or I couldn't have sustained the pace of running up a flight of stairs for a long, long time. We just get too darn tired. We need to start walking. That's what the market is doing right now. It's starting to walk up the stairs, but we're still going up, right? So before we get into some really detailed numbers, I just want to share with you some observations that we have. So this comes from all of our realtors up and down the Front Range. These are things that we notice in the market, things that we notice as we're helping sellers, as we're helping buyers. These are our big takeaways, our big observations about what's going on in the market. Again, I'm going to share these with you before we get into some really detailed numbers. So first of all, you need to know that all of the following are up. These following things are up. We show an increase in the following things. So we're noticing that it's taking longer for properties to sell. So no surprise as the market's starting to cool off a little bit as we're now walking up the stairs, not running. The time it takes to sell a home is increasing, so time on the market is up. Another thing that's up are price reductions. So the days of just throwing a high price on a property and knowing that the market is so frothy that someone's going to bite at that price, you know what, those days are over. So when we have sellers that are a little too optimistic or a little too ambitious, a little too aggressive with their pricing, we notice that the market is not biting. The market is not taking that price anymore. And so sellers who overprice on day one and get much too aggressive, they're having to reduce their price. An interesting little stat we noticed in Metro Denver is that recently there are just as many price reductions as new listings hitting the market. Isn't that interesting? I'll say that one more time. In Metro Denver, there are just as many price reductions today as new properties hitting the market. Okay, so what this means is that sellers, again, who are too aggressive on day one, they're having to reduce their price later in time as they notice that their market is sitting on the market. Now, what you also need to know, even though we notice sellers who are too aggressive with their price having to reduce their list price for their home, average prices are still going up. I'll show you the data behind this. So prices are still going up, not as fast as they were, but average prices are still going up even as the market is cooling off. So how about sellers? Here are some things that we notice about sellers. A couple things. Number one, seller concessions are more prevalent. So as the market is cooling a little bit, it also really depends on the price range, depends on location. We see that sellers are more likely to offer concessions offer things like they're contributing toward a buyer's closing costs, or they're just overall being more flexible with their buyers. An example of that is we see sellers, more and more sellers who are willing to accept contingent offers, especially in the higher price ranges. They are willing to accept an offer where the buyer needs to sell their home too. Back a couple of years ago, the seller would say, no way, I'm not going to accept a contingent offer. Today, they are being much more flexible. How about pricing when it comes to listings, and what do we notice about the pricing of a home, the pricing of a property? So what we know in today's market, based on what's happening, what we know is that pricing a property correctly on day one, it is paramount. It is so, so important to get the property priced correctly on day one, because sellers who overprice, what we find is that they're chasing after the market. So those ones, again, who get much too aggressive on day one, they reduce it a little bit and they still didn't find the right price, and then they reduce it more and more and more. And so how it comes across to the market is that they're chasing the market. So the process that we use in our company, we say it's like a car, all right? So it's like driving a car. So if you were to get an appraisal, what that's like when it comes to being like a car, that's like looking in the rearview mirror. So when you get an appraisal, what happens is you just look backwards. You look backwards over time. So we do more than that. We look backwards. We look out the rearview mirror to see what has happened. We're looking out the side windows of the car to see what's happening today. We're also looking out the windshield to see what's coming, what the trends are, where the market is going. So we take all those things into account when we go through the process of pricing a property. And you need to note, it is a thorough process to ensure that we help our sellers, that we get the property price right on day one, because we know it is paramount in today's market. Related to that is timing. It's really interesting to see what's happening with timing on the market right now. What we see is that some properties that would have sold, gosh, within hours a year ago, are now sitting on the market. And it's those ones that are overpriced, that are sitting on the market, that the seller just got a little too ambitious with it, or it's a case where condition is not exactly right. So this is a big deal to buyers, is condition. So condition is super important as buyers now become more picky. So one reason why a property might sit on the market is because its condition is not up to snuff. So that's why we go through a really detailed checklist with all of our sellers to make sure that they're hitting all the right points, that they're getting their property positioned right for the market, that its condition is the best it can be on the day that it hits the market. All right. So buyers overall, what we notice, are becoming more picky. By the way, at the end, you are going to be welcome to type in some questions to me using the same tool that you used to type me a note about your favorite football team. All right. So just so you know that, just know we're going to take some questions at the end. All righty. So the next thing on your mind, I'm guessing, is prices. All right. So what is going on with prices? This, of course, is a big question that we get. I'm going to show you our favorite source for price data, and our favorite source is called FHFA. So you can see that right here. The website is fhfa.gov. That stands for the Federal Housing Finance Authority. They track about 250 different markets all over the country. They've been tracking most of these markets for a long time. So what you're looking at first, the first example I'll show you, is essentially the Larimer County market. So this is Fort Collins and Loveland combined. This is going all the way back to 1978, so about 40 years of data. And each individual blue bar represents that particular year's appreciation. So just for example, where my cursor is right here, in 1995, prices went up 5.5% in that particular year. Let's go back here to 1987. That's when we were having some issues with the economy here in Colorado as it relates to oil. The oil industry was really changing then. It hurt the economy. So then prices went down 1.8%. So just to give you an idea of how this works and why we like FHFA is that this is a price index. So it's not just a simple calculation of average price. They track actual sales of actual homes to come up with this index. So you can see so far in 2019, this is not a whole year's worth of data, just like this little note says here. This is not a whole year's worth of data. So far this year in 2019, prices are up 2.7%. So right here, these past 5, 6 years, this is us running up the staircase, okay? So we knew that prices could not sustain this level. Eventually, the market would get tired, metaphorically, from running up those stairs. So this is now us walking up the stairs, but prices are still going up. So remember, I said before that all markets seek balance over time, and we can always find a trend over the long term. So this is the long-term trend. So for Northern Colorado, for Larimer County, if you pull the data from that graph I just showed you and you averaged it out over the 40 years, what you see is that the average price appreciation per year is just under 5.5%. So 5.42% is the average yearly price appreciation for Northern Colorado. Okay, so what this means is our market over the long term is predictable. Sure, it's going to have some ups and downs as we go along here. And you saw in the previous graph, there are many more up years than down years. But markets cycle over time, but they're always looking to seek balance. They're always trying to regress to the mean. If we were in economics class, then that is the long-term trend, 5.42%. So our market is predictable over the long term. And it turns out that our market is also predictable over the medium term. So this is, we find, is really, really interesting. So if you were to break up the 40 years of data into 10-year segments, again, what you find over the long term of the whole 40 years is 5.42% per year on average, but each 10-year segment has its own average price appreciation. So for example, this time frame from 1988 to 1998, prices went up 6.2%. Then the next 10 years, they went up 4% per year. By the way, this is a per year calculation. And you can see the most previous 10 years was a little over 6% per year. So our prices are predictable over the long term, and they're also predictable over the medium term. So these numbers are not too far away from the long-term average. So what this tells me, what this shows us, is that these prices are not taking big variations away from the long-term average, so that we can predict what prices are likely to do for the next 10 years. So what do we think prices will do for the next 10 years? Well, what we think they'll do is what they've always done. So over the long term, they've done about 5.5%. And in these 10-year segments, they've been pretty close to that 5.5%. So that's what we would predict to happen for the next 10 years. It should be about this if history is an indicator. So price is predictable over the long term, predictable over the medium term. And it turns out there's some predictions we can make, there's some certainty we can have even when it comes to the short term. And specifically what I want to show you is the fact that right here in the worst economy of our lifetime, prices went down at the maximum 2.2% here in Northern Colorado. So as Wall Street is melting down, as banks are going out of business, as unemployment is skyrocketing, this is what our prices did in Northern Colorado. I'll show you Metro Denver in a moment. It's pretty similar. So we had 3 years in a row of negative price appreciation, but adding up to, gosh, only around 4%, again, in the biggest meltdown that we've ever seen in our lifetime. So we get asked a lot about, is there a bubble? Well, this is what happened in the worst economy of our lifetime, and we don't really think that that's going to happen again, at least in this generation. But if it were to happen, this is the worst that could happen. We get sometimes some buyers say, geez, I'm going to wait for markets, or I'm going to wait for prices to come crashing back down. The thing is, they've never come crashing back down. This is what's happened when it got the worst of the worst. All right. So again, this is what happens every single year. We can make long-term predictions. We can make medium-term predictions. We can even make some really good educated guesses when it comes to the short term. So what about Denver? You're wondering about Metro Denver. I've been showing you Northern Colorado. Well, here's the same data, but now this is for Metro Denver. So again, FHFA tracks about 250 markets all over the country. Northern Colorado is one, Metro Denver is one. So this is what happened in the worst economy of our lifetime in Metro Denver. And by the way, if I was showing you like Phoenix, Arizona, or Naples, Florida, or San Diego, California, the bar right here would be negative 20%, negative 25%, negative 40% if I was to show you Las Vegas. So our market here along the Front Range is super resilient. When the economy gets really bad, things do not really go so bad in the real estate market, okay? So how about for the long term in Denver, Metro Denver? That's what we can predict for the long term because that's what it's done over the last 40 years, 5.5%. This is the same information broken up into those 10-year segments. Not a whole lot different from what I showed you before. With Northern Colorado, the markets tend to track each other. They tend to be really similar, no surprise there. So we can make really great guesses on what will happen for the next 40 years and what will happen for the next 10 years based on what's already happened. Alrighty. Now, interest rates is a huge deal. Okay. So interest rates, as I mentioned before, it's a big question that we're getting right now. People wonder what the heck is going on with these low rates. First of all, why are they so low? Well, there are really two big things that are driving the rates so low right now. It's number one, overall worries about the global economy. So the global economy is cooling off. That is pushing rates down. And then specifically for the United States, it's all the trade wars and the trade talk with China. That is also pushing rates down. So regardless of what you believe about that and if you think that's a good thing or a bad thing, the effect that it's having is it's pushing the interest rates down. So what you can see here, if you look at this graph, you can see that over here today, we are at 3.5%. So 3.5% is where we're sitting today. So there have been two other times, and I'm going to show you in detail more about these times, two other times in history where rates went down this low, only two other times. So this is one of three times in history where rates have hit about 3.5%. So one was October 2016, the other one was April 2013. I'm going to show you what happened soon after rates hit the bottom. So today rates are again at 3.5%. So 3.5% for a 30-year loan. What that is, that's essentially half off. So if you were to look at this data, this is over 40 years of data. And if you were to look at the long-term average of these rates over all these years, the long-term average is about 7.5%. So today's rates are more than half off of that. So we kind of joke and say, you know what, today money is on sale. Money is a great bargain. Money is creating incredible opportunities right now for buyers, specifically also investors. Investors have an amazing opportunity right now to get the numbers to look really good, whether you're looking at commercial property or residential property, single family, multifamily. We're working with lots of investors right now because the rates have been pushed down so low. It makes the investment numbers, the cash flow numbers look really attractive because rates are so low. So what about these last two times when rates hit bottom? So one time, and this is back here, was April 2013. Rates right there where my cursor is hit 3.41%. But look what happened just 4 months later. Rates hit 4.4%. So right there to right there is 4 months. In 4 months, rates went up almost a full point. So 0.99% is the difference between here in just 4 months. What about the other time? Well, the other time was October 2016. When rates went from 3.42% to 4.32%, that's a 0.9% difference. Again, almost a full point. That, my friends, is right here. So from right here to right here is that change in just 2 months. In 2 months, rates went up almost a full point. They went up 0.9%. So here's the deal. If history is any indicator, these low rates will not last long. So if history is any indicator, we could see a jump like this, a bump, just like we saw back in 2013, 2016. You should know that a year ago, rates were 1 point higher. So back here, 1 year ago, rates were 1% higher than today. Gosh, in January of this year, rates were 4.5%. So it's certainly not unheard of. It wouldn't be out of the realm of possibility. It wouldn't be out of the ordinary for rates to bounce back up to 4.5%, which, by the way, is a pretty darn good interest rate. So again, the last two times that rates hit this low, in short order, they bounced back up almost 1%. And just a year ago, and gosh, even 9 months ago, rates were at 4.5%. That is a big deal. That's important to know if you're a seller or if you are a buyer. All right. So, for example, I want to show you this. This is a question that we get a lot right now, and this is a comment that we get. The question is, so should I wait? Should I just wait to buy? You know, I'm reading the articles in the newspaper and online about what the market's doing, and of course, things tend to get sensationalized in the news about what's going on with the real estate market. Maybe I should just wait. So buyers say, you know what, I think prices will come down, maybe even by a lot. I think I'll just wait to buy. And so that's a comment that we get sometimes from buyers. And here's the deal with that. Prices have never come down by, quote, a lot. Okay, so people waiting for prices to come down a lot, well, that's never happened. I showed you back in 2008, worst economy of our lifetime, prices went down 2.2% only. So they did not come crashing down. The thing is, the stock market corrects. Our front range real estate market does not correct. Our front range real estate market pretty much chugs along. There'll be some moments where it slows down and maybe even dips into the negative, but only at a minimal amount, but it takes a really bad economy to make that happen. So our real estate market has shown no history, has shown no trend. There's no evidence really of our real estate market correcting like a stock market corrects. Our market, for the most part, pretty much just chugs right along. And the second point when it comes to this and this question about should I wait is the thing, interest rates will be higher. It's so likely the interest rates will be higher based on what I just showed you, and that impacts both buyers and sellers. I'm going to give you an example of this. So this is a listing that we have right now. This is a home that we have listed for sale. We're helping out these sellers in Timnath. This is a beautiful home. It's listed at $485,000. And so let's pretend that a buyer is interested in a home like this, but they say, you know what? I think I may just want to wait. I think I'm going to wait around. I'm going to see what happens in the market. I think prices maybe are going to come down, or I'm not so sure. But here's the thing. Today, if you were to buy that home with 20% down and you have a conventional loan at 3.5% interest rate, you can own that home for $1,742 per month. If rates were 1% higher, it goes up to $1,965 per month. That is a 13% increase. All right, so a 13% increase will occur if rates go up only by 1%. And guys, that is the exact same as the house going to $548,000. So a 13% increase on $485,000 would mean that price is effectively priced at $548,000. So a year from now, even if prices didn't change at all, even if prices would still be, and that home would still be priced at $485,000, if rates were 1 point higher, it's now at $1,965 per month, which is the same as the price of that home going up 13% to $548,000. So that's why, that's a specific tangible reason why it does not make sense to wait, because rates are so low. Even if you don't see prices going up 10% or 13%, we do see it's so likely that rates will go up, and that has the same exact effect on a buyer. And the thing is, this also affects sellers. Sellers who are wondering if they should sell now, if they're kind of on the fence, well, this dynamic will have a big effect on the price that they can achieve for their home in the future, because of the effect it has on the buyer and the buyer's payment when they're getting a loan on the property. When rates go up, it's effectively a price increase that the seller never gets to realize. So even if you're a seller who's wondering if now is a good time, it is a good time because rates are so low. So interest rates going up, it creates risk for both the buyer and also for the seller. So the good news, what we see right now, is that finally inventory has gone up. So for many years, this was the lead story when it came to real estate, especially front range real estate, is the limited inventory. There were few selections for buyers to choose from, but still high demand, and that's what caused all the bidding wars. That's what caused the multiple offers. That's what caused buyers to say, oh my gosh, this is way too frenzied for me. I don't like this. I wish I had more choice. But you know what? Today, the great news for buyers is you have much more choice. I'm going to give you the specific numbers behind this. So in Metro Denver, right now, there are 9,350 homes for sale. That's a 14% increase over 1 year ago. So the inventory has jumped 14% compared to a year ago. I'm going to put that 9,350 though in perspective for you though, all right? So this is important. I'm going to put it in perspective. So the long-term average for this time of year in Metro Denver is 16,761. So that's today we're only a little over half of what the long-term average is. The lowest it ever got was 2016, where there were 7,000 327 homes for sale. Okay, so there are essentially 2,000 more homes for sale today compared to the low point. The highest it got was 31,000 homes were for sale in 2006. So we get asked a lot, is there a bubble? One thing that causes bubble is oversupply. In 2006, there was more than 3 times as many homes for sale as there are today. So the good news is that inventory has gone up. The reality is that compared to history, though, inventory is still low. So we have no concerns over the market being oversupplied when you look at the historical numbers. So here are the numbers for both Larimer County and Weld County, two other places where we do business, and you can see a similar trend in terms of the increase. So Larimer County, great news for buyers, 11% increase in inventory. Weld County, a 21% increase in inventory. We have more selection now for buyers, and we are really, really happy about that. And our buyers are also super happy about that. All right, so what about a recession? So this is a question that we get a lot. There's talk in the media about a recession. Some people think that it's being kind of sensationalized for political reasons. And so what I did is I tried to cut through that as I did the research on this. And I found that there was a recent, very recent, like in the last 2 weeks, a survey that was done. And this was done through the National Association for Business Economics. And they went out and they surveyed 226 economists. So these economists live all across the country. And these are economists that work for individual firms or they work on their own. All right. So they're maybe freelance economists. They're not necessarily tied to a specific investment firm, for instance. So it's a mixture of both. Okay. So these people work for specific firms or they work on their own, 226 different people. So a really wide sampling. So 38% of these people think a recession will happen next year, in the year 2020. And then about a third think that it will actually occur in 2021. What's getting hyped up in the press is that if you add these two numbers together, that's 72%. So 72% believe that a recession will happen by the end of 2021. And what does that leave? 28% think it will be sometime in the future. Is that definitive? Is this definitive data? I guess not really. One thing we can know, though, is that a recession will happen. It's likely it will happen, gosh, certainly within the next 4 years, maybe even 3. 72% think it will happen by the end of 2021. So we do know that a recession is going to happen. Our chief economist in our company, Matthew Gardner, has a great funny expression. He says, simply recessions happen. All right, so recessions happen. It's just a reality of the economy. Recessions happen over time. I found this really great graph to put this in perspective. And you should know this is a website that I follow. You can see right here, calculatedriskblog.com. Terrific economics website. They have lots and lots of information about housing specifically on there. The person that writes this blog, he's a genius, has great data, great information. So I got this graph from him, and I think this does a really good job of putting the most recent recession in perspective up against a, quote, more normal recession. So the most recent recession, of course, is this red line, and that was the 2007 recession. And so what this line shows is two things. Number one, it shows what the unemployment did, or the percent of jobs that were lost. So this is kind of the depth of the recession. And then it shows the length of time that it took to recover all those job losses. So in this graph, you're seeing for all the different recessions that happened, how long did they last? And also, in essence, how deep were they? How impactful were they when it came to number of jobs that were lost? And so what's obvious when you look at this is that the most recent recession was much different than really any other recession we've had, again, in our lifetime, going all the way back to the 1948 recession. It was much longer, it was much more impactful. So when it comes to recessions and what people believe and think and kind of the feelings and perceptions that they have about a recession, the challenge is that what people think and feel about it is based on the most recent one, which isn't at all like a, quote, more normal recession. So some things I've been reading predict that the next recession we'll have may look more like the 1990 recession. So just look at this recession here in 1990, the black line. So about 1.5% job losses, and it took about 32 months for jobs to recover, so a quote more normal recession. This most recent one that we had was not more normal. So the takeaway is we are going to have a recession. It's inevitable. And it's likely that it's going to look a whole lot more like these than like this. There were just some extra dynamics going on here, some very odd things, some things that were combined to make this recession so impactful. So again, these are all the different recessions that happened. So most recently, 1990, 2001. So put that up against the same pricing chart. So let's go back here, 1990. So maybe it started in 89. So the 89, 90 time frame. So that's kind of what a last recession looked like. And then a 2001 recession, well, that didn't impact Northern Colorado really at all. It just kind of tapped the brakes on price growth. And we've talked about what happened here, that red line, the worst economy of our lifetime. So if a recession does happen, we expect it to be just kind of a tapping of the brakes, because that's what history has shown. We're going to be still walking up that staircase, not running up that staircase anymore, because our front range market is so resilient. And here's why. It turns out people like Colorado. And that's why there's so many more people now on I-25. I was born and raised in Denver. I noticed a whole lot of changes in the state compared to 49 years ago when I was born, because there are a lot more people who live here. It turns out people like living here, just like you and I like living here. The reason why I'm showing you this picture of Mile High Stadium is the fun fact is our state grows in population. The net population growth is roughly the equivalent of a Mile High Stadium's worth of people. So our state's growing at about 77,000 people per year net. That's net growth. And that equates to about a Mile High Stadium's worth of people. And people ask, so where are these people coming from? Well, they come mainly from 4 places. They come, no surprise, from California. They come from Arizona. They come from Texas, and they come from Florida, of all places. So they're coming, it seems like, from hot, dry places to our place, which maybe it's not as hot, but still has all the amazing amenities that we have here to offer. This is why, folks, this is why our market is proven to be so healthy over the long term. There are strong fundamentals here in place. We have a place where people like to live. We have a place with a strong, diverse economy. That is what drives our real estate market. If you like things like this, if you want more information, this is one way that we can help you out. So at Windermere Real Estate, we are committed to being your trusted source of information. And one way we do that is with our chief economist quarterly report. So this is a picture of our chief economist. His name is Matthew Gardner, and he is a genius. He's a wonderful person. He has lots of great information online. You can even track down some of his videos and blogs that he writes. And this is his quarterly market report. It's called the Gardner Report, and we'd be happy to get this in your hands. So what you want to do is just reach out to your Windermere broker, and they can get that emailed right over to you. And this, we think, will give you a whole lot more clarity on what's going on in the market. One thing that Matthew is famous for is his speedometer. So he has a buyer-seller's market speedometer that does a really good job of clarifying where the market is today in terms of its balance versus being a buyer's market or a seller's market. So again, we'd be happy to get this in your hands. Just reach out to the Windermere broker that invited you onto this webinar, and we can do that for you. Okay, so with that, it's looking like perfect timing, and I have a lot of time to answer questions for you. So this is your chance to type in a question to me, and what you need to do is use the same mechanism, the same tool that you did to type in your comment about your favorite football team. If you have a question about what's going on in the market, maybe it's something I didn't cover, maybe it's something that you want a little more clarity on, I'd be happy to do that for you. Just go ahead and type in a question, and I'll be able to see it here on my dashboard, and I can go ahead and read that to the whole audience. And it's a way for all of us to learn from each other, okay? So let's see. One question that came in is, so where specifically do you see opportunity? Where do you see opportunity right now in the market? So I kind of mentioned it before, and that the biggest opportunity, or one of the biggest opportunities we see right now, is for investors, all right? So because rates have come down so much, we see a terrific opportunity right now for investors. And there are some potential investors that kind of got misled or maybe disenchanted because prices were going up by such a significant amount here in the recent future. So there were some people who jumped to the conclusion and made the assumption that the numbers weren't going to work anymore based on what appreciation did. And that wasn't necessarily the case, because we continued to see rents keep going up. And now combine that with what rates have done, we're seeing lots of investors jump back in to the market and look. And so we've been helping lots of investors right now. So that's one specific place that we see some opportunity right now. Let's see. Let's see. Do you think, here's a question that came in. Do you think that the consistent increase in housing costs will cause a slowdown in the migration to Colorado? Will it become, quote, too unaffordable like California? I don't think that, for two reasons. Number one, I see builders getting more and more creative when it comes to offering housing that hits the price point where most of the market exists. So builders have always been so responsive and so creative when it comes to the market. So now what we're seeing them do, we're seeing them get creative with the size of a home, with the size of the land that the home is on, more clustering of homes, a little more density, which of course helps with the price. There's also an environmental factor to that, which is to the positive. There's some people who are against sprawl, and the way to not have sprawl is to have more densely um, uh, developed product. So we're seeing developers respond to that. And you know what? When it comes to housing and prices, it really ties back to jobs. And the deal in Colorado is that we have a very, very healthy economy, an economy that's proven to outperform for the long term. And so that's what sustains housing prices. That's what causes someone obviously to be able to afford a payment. So if you look at GDP growth versus the nation, if you look at unemployment versus the nation, Colorado has consistently outperformed. And so that's what gives us confidence about the long term in Colorado. Um, let's see. What other questions do you have? Um, let's see. Here's one. Eric, do you see recent obvious differences in buying behavior between people of different age groups that's different from the past? One thing we notice based on the research that comes out of the National Association of Realtors is that, no surprise, millennials and a younger generation, they tend to rely more on the web to gather information. And another thing that's really interesting in the research around millennials and their buying process is that they tend to rely more on their peers. So they really look to have feedback from their peers about the price, about the process, about where they're looking. Are they doing the right thing? Would their friends be on board with this? Do their friends approve of the decisions that they're making? So I don't know if that's just because they're younger and they have less experience doing this, and that's why they're looking more to the kind of the outside to get approval and get their peers' input, compared to say baby boomers are not as reliant at all on their peer group. They're more apt to kind of work independently and work hand in hand with their realtor, as opposed to look to their peers for input and guidance. All right. Um, let's see. There's speaking of age. Okay, so here's a question that just came in. Speaking of age groups, who do you think will see as the biggest population of buyers in the next few years? Boomers downsizing, millennials buying their first or second home, Gen X. Well, simply just based on the population size and based on demographics, the two most active groups are going to be boomers downsizing and millennials buying, and only because there are more of them. So if you just look at the simple demographics of boomers, they're the second largest population group right now. They're hitting the time of life where it's time for them to downsize. And then the millennials right now are the largest population group, and they're just now entering their prime buying years. So we think that will be another significant factor in the market. Gen Xers are certainly doing well when you look overall across the country. They're doing well financially. There are certainly an age demographic where it's making sense for them to buy and sell, but there just aren't as many of them, or I should say as many of us. So I am a Gen X. There are many more millennials and many more boomers, so those are going to be the most active people buying. Here's a question. With opportunity for investors in higher density neighborhoods being built by developers, do you find more value with investing in homes on larger lots? Well, the value there would be you would own something different compared to what's going to be happening in the future. And we always say when it comes down to investing, it really comes down to the numbers, all right? So when you're looking at investing, and if you're comparing two options, we just like to run the numbers. So we have a really detailed spreadsheet that we use to analyze properties. It's something anyone listening, we can help you with. We can run the numbers for you so that you can compare any opportunity side by side, and it becomes a very black and white decision. And what's nice about it is you don't have to guess or make a whole lot of assumptions. You're not at all going on your gut. You're going right on the numbers. And so the spreadsheet that we've developed has proven to be super valuable. All right. So I'm just going to pause for a moment to see if there are any other questions that came in. Those are all great questions, by the way. With lots of people listening in live, which is fantastic. And I know that based on the registrations that we have, we'll have lots of people listening to the recording. And this will also get used by our realtors as they meet folks in the future, over the next few months who are curious to know what's going on in the market. We know this will be a valuable resource for them. Okay, so a few things to wrap this up. One, again, if you would like that Gardner report, which is our chief economist's quarterly report, reach out to the Windermere realtor who invited you onto this webinar. We'd be happy to get that in your hands. If you really like things like this, be on the lookout for our live event that we do every January called our Market Forecast. And that's where you can come to an event to see data and stats like this. It's a more in-depth presentation because we go on for a little bit longer, and that's also where we make our predictions for the coming year. We do two of these events, one in Northern Colorado, one in Metro Denver. If you're on this webinar, we will make sure that you get invited to that because if you really enjoy information like this, we think that will also be enjoyable to you. So I want to thank you again for being a part of this webinar, for engaging with us, whether you listen live or listen to the recording. Again, my name is Eric Thompson. I'm with Windermere Real Estate. You have my email address right there. So if you have questions after the fact that you have for me, I'm welcome to and happy to help you with those questions. Just go ahead and pop me an email. In the meantime, I hope you have a terrific day. And you know what my favorite team is? My favorite team is the Broncos. And so how about go Broncos? Let's see a rebound this coming weekend. I'd love to see them turn around. Thanks again for listening. Have an excellent day. Bye.